Now let's bring in our first guest, and quite frankly, one of my best friends in the entire world, Greg Melia from Melia Advisory Group in Tulsa, Oklahoma. Greg, thanks so much for being here on the show today with really what is a lot of short notice. We just let you know a little while ago. We appreciate you taking the time out of your busy schedule.
You're welcome. I'm glad to be here.
You know, it's funny. You really, I started the income model 20 years ago and brainstormed it, as you know, just because I was concerned the market was going to crash from the tech bubble. You joined the effort about 12 years ago, and you took the ball and you held on to it and you ran with it. And I almost feel like you and I together, side by side, have really worked to make the income model what it is today. So let's start by asking you to tell our income generation viewers in your own words, what is it about the income model in simple terms that makes it so right for most investors who are retired or within 10 years of retirement?
Boy, that's a loaded question. I think for me, it came from all the sob stories, and I'm sure you've heard them too, that people that have lost their life savings in the market and they're crying because they were trying to take income from a growth model and it ended up destroying their finances. And, you have advisors keep singing the same song, just stay the course, hold on, don't rock the boat. Through them, as these clients are telling me the process they went through of losing their assets and just getting the same answer every time, just buy and hold. You're going to be okay. The market always goes up. You know the mantra.
So, and that's a good point, because some of these people might not have run out of money until advanced ages or maybe even after they died. So for some people, they could use an unhealthy financial strategy, and a lot of people, through luck, will be able to get away with it successfully. So it's not just that you flip a switch at some point and you're out of money. But the income model, to me, is a lot about keeping good mental, emotional, as well as financial health, so you can enjoy your money and not stress about it through all those years, throughout your life expectancy. How does that play into this from your standpoint
Well,
with your
actually,
clients?
I talk a lot about the psychology of retirement, that it is more than just about the money. Most people, but at this point, they've experienced two drops of greater than 50%. And once you explain the destructive nature of trying to take income from a growth model in a down market, especially if they understand that, they know they're just waiting for the shoe to drop the entire time. In fact, they usually come into my office. We've had 6 years of a bull run, or a little bit longer than that, and they know it's coming. And they've been through two drops already at this point, and so they're fearful. They know, yet they don't know what to do, and so they hang in. Just the advisor to stay the course and rock the boat. But the psychology of retirement, is really a critical element of being happily retired. And most people today, I find, are worried about the stock market, and that's not a way to be retired.
So talk about the psychological argument then, this whole issue. What do you say to people when you tell them, look, you can get 5% net of fees through the I instead of the G, through interest and dividends? And people say, well, that can't be. It's too good to be true. My advisor told me the most you can get in bonds and bond-like instruments, 2 or 3%. How do you answer that?
Well, it's actually a fairly easy answer. I explained the nature of mutual funds versus bonds, which, as you know, is if you hold the actual bond, you get a fixed rate of interest, and you get a maturity date where you get your money back. So even the bond value, if the value goes down, it doesn't matter in the end. And with bond mutual funds, you lose both of those. You can lose money just like you can a stock mutual fund, and that's misunderstood today. And once they understand that, that's a real eye opener for them.
So people come fixated sometimes with, I need X amount of dollars to retire. When it's really not about the lump sum, it's about the amount of income it generates that you should be focused on for retirement. So in the 30 seconds we have left in this segment, how do you speak to that when somebody's fixated on this number of net worth they feel like they need to achieve?
Well, I explained to him that it is the more valuable question is how much income can you take from the account balance versus the size of the account balance. And I like to ask a simple question. If you had $1 million and it produces 20,000 a year, it only produces 20,000 a year in income safely versus an account that has a $500,000 but produces 30,000 a year safely. Which one would you value more? The one that produces bigger account balance with less income, or the smaller account with bigger income, and they always choose the latter.
They choose the one with more income, absolutely. We need to take a quick commercial break, Greg, so stay with us. You stay with us too. We'll be back here in a moment on the income generation. I'm David Scranton, and we'll be right back. Now let's bring back Greg Melia from Melia Advisory Group in Tulsa, Oklahoma. Greg, thanks for sticking around.
Hey, you're welcome.
So I get the logic behind it that people say, yes, I'd rather have 500,000 that gives me 30,000 a year than have $1 million account that only gives me 20,000 a year. But that's the logic side. There's an emotional side to this. We have a whole generation of people, baby boomers, income generation members, that are addicted to the stock market because they got serious about investing in the 80s and 90s, the best market in U.S. history. So how do you break through that addiction?
Well, I frequently, I tell stories of my experiences that people have come in, they're addicted to the stock market, listening to their advisor. There's two in particular that really stand out that just came in these last few months. One retired in 2000 with $1 million, and they did the old 4% rule. They didn't take more than 4%, and they're now in their mid-70s facing bankruptcy as a result of what's happened to them through taking income from a growth strategy. Then I have another couple's 1.4 million that are now they retired in 98. Now they're just a little over 400,000. They're panicked because they know they have another $1 million to blow through. And so when you run into and you explain those stories to what happened to them, and then the fact is when you explain to those that are the people are sitting in front of you, if they just had 4% income, that's it, just 4%, they would still have that principal day and they'd still have their income instead of facing lifestyle bankruptcy.
Now, a lot of people, though, have this misconception that, gee, if I want to get more income from my investments, I need to take more risk. When really the opposite is true, correct?
Really true, absolutely. That's the point I bring out. My definition, I tell anybody that walks in my office, my definition of a perfect retirement is have more income than you need till the day you die. And if you have that, that is a successful retirement. And income is the answer to every problem that comes your way in retirement, regardless whether it's paying for health care, long-term care needs, higher premiums on your insurance, taxes. It all boils down to having enough income. What do you want, a vacation, travel? It's all about income.
It's funny because you probably get some of the people that I see where they say, well, between the two of us, we're making about 100,000 right now. When we retire, we did our budget, we only need 50,000. Because we're saving money, we're doing some things, we only need 50,000. When most people don't realize how expensive retirement is, right?
Mm-hmm. Absolutely. Yeah, just sit down and actually have them run the math on the numbers of what the actual income dollars they need, and let them realize. Some people have the mistaken notion that they don't have to pay taxes. That's a big one I see. They don't realize you have to pay taxes in retirement, and that's a hard pill to swallow for some retirees.
So speaking of taxes, I've got a pension. I'm making over 100,000 a year from a pension and Social Security. I don't need any more income, so I can invest for growth. But I'm turning age 70 and a half next year. Why is that person wrong? Why does that person need to focus on income too if they're turning 70 and a half, even if they think they don't need it?
Well, as you know, they're going to be facing RMDs, required minimum distributions. They're going to require them to take money out, which is going to require them to sell assets to answer those RMDs, which again puts them in the same boat as anybody that needs the income. And that's selling assets, and the risk is in a down market. And as well as it's based on the December 31st balance. The RMDs are based upon that. And, the market drops between here and then, and, as it did in 2008, 9, then they're going to be based on those RMDs on a much higher account balance and being forced to even take more out.
So everyone who has a 401k or an IRA needs to make that transition at some point between age 60 and 70 from growth to income. Greg, thanks so much for being back on the show. I really appreciate it, and I look forward to talking with you next time. Stay with us. We'll be back in a minute right after the commercial break. You're watching The Income Generation. We'll be right back.